Hey everyone, it's Tony here. So I need to talk to you about something that's been all over the financial news lately, and honestly, it might affect your retirement savings more than you think. You know that classic investing advice? Put 60% of your money in stocks, 40% in bonds, and you're good to go? Well, that rule has been around since the 1950s. But here's the thing. Some of the world's biggest investment firms, including BlackRock and JP Morgan, are now saying it might not work the way it used to. And before you panic, take a breath. Because I spent the last few days reading through all these reports, all these financial documents, so you don't have to. And I'm going to break down what's actually happening, who this affects, and most importantly, what you can do about it. But first, let me tell you about something that actually helped me get my own finances in order. So first, let's talk about what the 60/40ths rule even is, and why it became so popular. Back in 1952, a guy named Harry Markowitz, who later won a Nobel Prize, basically created modern portfolio theory. The idea was simple. Don't put all your eggs in one basket. Mix stocks and bonds together, and when one goes down, the other usually stays stable or goes up. For decades, this worked beautifully. If you put 60% of your retirement savings in stocks and 40% in bonds, you got growth from the stocks and safety from the bonds. It was like having one foot on the gas pedal and one near the brake. Balanced, safe, predictable. And the numbers backed it up. According to recent data, this strategy delivered solid returns, 16% in 2023 and 18% in 2024. Not bad at all. So why are people saying it's dead? Well, that brings us to what changed. Here's where things get real. In 2022, something happened that wasn't supposed to happen. Both stocks and bonds fell at the same time. The traditional 60/40ths portfolio lost about 16% that year. For context, that was one of the worst years for this strategy in modern history. The last time both stocks and bonds fell together was 1969. So what went wrong? Inflation came roaring back. The Federal Reserve had to raise interest rates faster than they had in decades. We're talking about the sharpest rate increases since the early 1980s. When interest rates go up, bond prices go down. And when inflation is high, stocks struggle too. Suddenly, bonds weren't protecting people anymore. They were losing money right alongside stocks. That safety net everyone counted on, it had holes in it. As one investment strategist put it, the relationship between stocks and bonds that protected portfolios for decades essentially fell apart when inflation spiked. Now, if you're watching this and thinking, does this affect me? The answer is probably yes, especially if you're saving for retirement. You have money in a 401k or IRA. You're already retired and living off your investments. You use target date funds. These often follow the 60/40ths approach. This affects regular people, not just Wall Street types. We're talking about teachers, nurses, small business owners, anyone trying to build a nest egg for the future. And here's what makes it really challenging. If you're retired or close to retirement, you can't just wait 20 years for things to bounce back. You need your money to last, and you need it to be somewhat predictable. According to Fidelity, an average retired couple might need around $315,000 just for healthcare expenses in retirement. That's on top of everything else. So the pressure to get investing right is real. Okay, but here's where I want to hit the brakes on all the doom and gloom. Because despite what some headlines say, the 60/40ths portfolio isn't completely dead. In fact, as one portfolio manager put it, saying the 60/40ths is dead would be like saying portfolio diversification is dead. And diversification is more important than ever. The strategy bounced back strong after 2022. Remember those 16% and 18% returns I mentioned? That happened right after the worst year. During a recent stock market dip, a 60/40ths portfolio only lost about 4%, while the S&P 500 dropped 9%. So bonds are still providing some cushion, just not as much as they used to. And that's the key. It's not that the strategy is completely broken, it's that it needs some updating for today's world. Think of it like this. The 60/40ths rule is like a classic car. It still runs, but maybe it needs some new parts and a tune-up to handle today's roads. So here's what financial experts are now recommending, and this is the part you really want to pay attention to. The big shift? adding what's called alternative investments to your mix. Now, I know that sounds fancy and complicated, but stay with me. Instead of just stocks and bonds, experts are suggesting a mix that might look more like 60% stocks, 30% bonds, 10% alternatives. So what are these alternatives? A few things. Gold. It's been up around 29% this year, making it one of the best performing assets. Gold often moves differently than stocks and bonds, so it can provide balance. International stocks. U.S. stocks have been concentrated in just a few big tech companies. International stocks give you exposure to different economies and opportunities. Real estate and infrastructure. These can provide steady income and often do well during inflation. Managed futures and hedge fund strategies. These are now available through regular investment accounts, ETFs, not just for wealthy people. They're designed to make money even when traditional markets are struggling. According to BlackRock, about half of their clients are now looking at these alternatives for diversification. And investment flows have been shifting. People are putting more money into these non-traditional options than ever before. The key is that these alternatives don't all move together. When stocks are down, some of these might be up. When bonds are struggling, others might be stable. It's about having multiple shock absorbers instead of just one. Now, I want to be really practical here because I know this can feel overwhelming. First, don't panic and sell everything. Seriously, the worst thing you can do is make big emotional decisions when markets are uncertain. Second, start small. You don't need to overhaul your entire portfolio tomorrow. Financial experts suggest starting with a 10 to 15% allocation to alternatives, not going crazy with it. Third, consider your timeline. If you're 25 and just starting out, you have decades to ride out market swings. If you're 65 and retiring next year, you need a different approach. Your portfolio should match your situation. Fourth, keep it simple when you can. Some experts are recommending target date funds or balanced funds that automatically adjust these allocations for you. You don't have to become a financial expert to do this right. And finally, the most important thing, don't let perfect be the enemy of good. Having some diversified investments is way better than having no plan at all because you're overwhelmed by choices. Look, here's the honest truth. Investing has always been about managing risk and uncertainty. There's never been a set-it-and-forget-it strategy that works forever without any adjustments. The 60/40ths rule worked great for decades because we had generally low inflation and declining interest rates. But the world has changed. We've got higher inflation, more economic uncertainty, political tensions, and government debts that are bigger than ever. But, and this is important, we also have more tools and options than investors have ever had before. Alternative investments that used to be only for billionaires, now available in regular retirement accounts. International investing, easier than ever. Information and education, you're literally watching it right now for free. The financial industry is adapting, and so can you. So what should you actually do with all this information? If you're young and just starting out, stick with the basics first. Contribute to your 401k or IRA. Consider a simple 3-fund portfolio: U.S. stocks, international stocks, and bonds. Don't stress too much about alternatives yet. Building the habit of saving is more important. If you're mid-career, review your current allocations. What do you actually own? Consider adding some international exposure if you don't have it. Look into adding a small allocation, 5 to 10%, to alternatives like gold or a diversified real asset fund. Maybe talk to a financial advisor about your specific situation. If you're near or in retirement, this is where you really might want professional advice. Think about shorter-term bonds instead of long-term bonds for part of that 40%. Consider alternatives that provide steady income, like infrastructure funds. Make sure you're not taking more risk than you can afford. And for everyone, educate yourself, but don't let information overload stop you from taking action. Sometimes done is better than perfect. Here's what I want you to take away from all of this. Yes, the investing landscape is changing, but you're not powerless in this. The 60/40ths rule served generations well, and versions of it will continue to serve people well, just with some modern updates. It's not about abandoning the principles of diversification. It's about expanding them. You have more options, more information, and more flexibility than previous generations. And while that can feel overwhelming, it's actually a good thing. The goal isn't to get rich quick or to perfectly time the market. The goal is to steadily build wealth over time, protect what you have, and give yourself options for the future, and that's still completely achievable. Whether you stick with a traditional approach or adjust to include some alternatives, the most important thing is that you're thinking about it, you're learning, and you're taking steps forward. All right, that's what I learned from diving deep into all these reports and articles. I hope this helped break down what's happening in a way that actually makes sense. If you found this valuable, do me a favor. Hit that subscribe button so you don't miss future videos where I break down this kind of stuff. I've got more content coming on retirement planning, investing basics, and money strategies for regular people. And hey, drop a comment below. I want to know, are you sticking with the traditional 60/40ths, or are you considering adding alternatives? What's your biggest concern about investing right now? Let's talk about it. Also, if there are other financial topics you want me to research and explain, let me know. I'm here to make this stuff less confusing. Thanks so much for watching. Remember, you've got this. Take it one step at a time, keep learning, and don't let fear keep you from building the future you deserve. I'll see you in the next one. Take care.